For today's main topic, we're going to be talking about turnover ratios within mutual funds and how they somewhat relate to our Monopoly example. With the Monopoly game, when we owned a home and we sold it in order to attain the capital to invest elsewhere, we ended up incurring some expense. In the game of Monopoly, you only get back half of whatever you put into a home. Now, this might not be very reflective of reality when it comes to actually dealing with real estate, but it's something that can very well reflect the principle of how mutual funds work, and that's going to be capital gains through turnover. See, when you own a mutual fund, your share of that mutual fund is broken apart into a bunch of different stocks or bonds, different securities. And the ratio to which that mutual fund owns different securities is managed by a fund manager. Now, this fund manager may very well want to change the ratios of what they own, maybe sell something within the portfolio, within the mutual fund, that doesn't seem to be doing as well, or they don't expect to do very well in the near future. Kind of like how in the Monopoly thing, we could bulldoze the houses on the pink properties in order to go develop the green ones. And here's what happens within a mutual fund. When you sell some of those shares, if they have appreciated, you are going to incur something called capital gains. There was a gain that's realized, or maybe even a loss, depending on how the particular security changed. Let's say it's a gain for this example. Let's say it doubled in value. Well, that gain, if it's in a taxable account, is taxable. Just like if you're buying and selling single stocks outside of a mutual fund, when you buy a stock or a bond, and then you sell it within a year, you incur short-term capital gains. And if you were to hold on to a security for longer than a year before you sell it and you had a gain, well, it gets taxed at a different rate, long-term capital gains rates. And this is as good a point as any to remind you that this podcast is not offering tax advice nor investment advice. It's for informational, educational purposes only. Please refer to the disclaimer in the description. Okay, so when a share is sold within a mutual fund of some security, in order to come over and buy a different security, capital gains can be generated. Now, it's interesting. If you're buying securities yourself, trading them around, not within a mutual fund, but on your own, those capital gains would be realized by you. You'd be able to see that cash and allocate it accordingly, either hold on to it or utilize it to go purchase other securities. Within a mutual fund, by default, most of the time, the capital gains are going to be reapplied to the mutual fund to purchase another type of security. To my understanding, because taxes are associated with this, there are certain mechanisms within certain brokerages that allow you to have access to the capital gains generated by your share of a mutual fund. And if that's something that interests you, I'd highly recommend that you talk to a financial advisor to explore that in more depth. But let's get back on track. What does this mean? Why does the turnover and generation of capital gains matter to you? Well, if you are in the taxable account, it can generate taxes. Some funds will do this a lot, moving securities around within the mutual fund a lot. There is a number within a prospectus for any given mutual fund called the turnover ratio. The turnover ratio indicates what percentage of the portfolio is turned over every single year. For example, I've seen some mutual funds where the turnover ratio is over 300%, meaning 300% of the securities that are in the portfolio are turned over every year. But that's more than 100%. That just means that 100% of the portfolio is being turned over every third of a year. So the whole portfolio within the mutual fund is flipped over a total of 3 times every year. That means that if you own this 300% turnover ratio mutual fund in a taxable account, you can expect to be paying taxes on any gains and losses that are realized during the turning over of that portfolio within the mutual fund. You may not have been doing any of the buying and selling yourself, but you're an owner of those securities when you own a mutual fund, so you're just as liable for the taxes therein. There are other types of mutual funds out there that don't have as high of a turnover ratio as the one that I just used as an example. Something that has a low turnover ratio typically is something that tracks in indices like the S&P 500 or the Dow Jones. An index mutual fund is going to have a turnover ratio that could be lower than 10%, meaning that of what you have invested in that mutual fund, you're only going to be seeing capital gains generated from around 10% of it or less, whatever the turnover ratio is, every year. That's the percentage of what you own that you'll be seeing generating capital gains or capital losses. keeping in mind that taxes are only going to be applying to the gain from what's turned over, not the total of what's being turned over. So it'd be inappropriate to say that you expect to be taxed on 10% of a mutual fund investment if there's a turnover ratio of 10%. Some of that turnover is going to be based in the principal amount that was initially invested to buy the security that was turned over. So why does this matter to you? Taxes, in the case that you are investing in a taxable account or a brokerage account. But what if you're not investing in a taxable account? You're investing in a tax-sheltered account, like a Roth IRA or a Roth 401k. Well, those capital gains that are generated there are not necessarily taxable the way that a taxable account is. It's kind of like being able to play Monopoly with someone who doesn't understand the rules that when you sell the house, you only get back half of what you put into it. You can move the security or move the house from one location to the other without incurring that inefficiency, without incurring that tax. And this is because the retirement accounts that are tax sheltered can grow tax-free. Roth accounts grow tax-free. When you withdraw from them, the funds that have accumulated within them are not taxed by the IRS. That's not true for a tax-deferred account. That's true for the tax-free growth of a Roth account, Roth IRAs, Roth 401ks, and alike. If you have a tax-deferred account, you're going to be realizing taxes when you are taking a distribution from the portfolio. But when you invest it into that tax-deferred retirement account, you were able to get a tax break for that given year that you made the contribution to the account, more or less deferring taxes down the road. All this to say, when you're investing in a tax-sheltered retirement account, we don't have to worry about turnover ratio as much when it comes to the tax generation because, well, it's tax-sheltered. There are other concerns that turnover ratio may lead us to want to dig into, but that's outside of the scope of this particular episode. Now, if all went according to plan, this is a shorter episode of the podcast than normal, but the lesson herein is one that's going to build into a much more valuable episode later this year. So I want you to remember this lesson about capital gains and turnover ratios, not just for understanding the tax implications that can happen when you have a high or a low turnover ratio in a taxable account, but the fact that capital gains are still being generated within tax-sheltered accounts, because just the nature of that mechanism is going to be fundamental to understanding a very cool topic that I'll introduce later. So until I get to that episode, and until next Tuesday, budget bravely and enjoy your hope-filled financial future.